Good morning, everybody. This is Steve Clemens, Vice President of Life Markets here at URL. Thank you for joining us for our first Friday webinar here for the month of April. We're very excited for today's presentation. We have a guest speaker from Ameritas, Eric Ojeda, who's an internal wholesaler at the home office, who will be discussing the FLX index product that's brand new to the market. With living benefits. So very excited to have Eric with us today, and in a little bit I will introduce him and pass the torch over to him to take over for the meat and the potatoes of the meeting. Before that, I just wanted to go through a couple house cleaning items and some information. And being that it's April and hopefully spring is on the way, talking to Eric just a few minutes ago, who's out in Nebraska, with seeing snow coming down and weather in the 20s, and myself here in Harrisburg, Pennsylvania, and weather, not a little better than that, but not much. We're kind of hoping for some warmer days. And the one thing that April always reminds me of is baseball. As a baseball fan and a coach of Little League Baseball and on the board of a Little League Baseball Association, I always think April and I think baseball. So I wanted to start today's presentation with a couple quotes. And today, not that I'm a Yankees fan, but I always love this quote and have a respect for Derek Jeter and his play and the way he played the game. I think it's one of the greatest quotes, and it can be used in kind of anything you do. There may be people who have more talent than you, but there's no excuse for anyone to work harder than you do. I think it's a great quote and fantastic from Derek Jeter. And the other is from the great Hank Aaron. It took me 17 years to get 3,000 hits in baseball. I did it in one afternoon on the golf course. So I can appreciate that. As a fan of both baseball and golf, it's a great quote. And two guys who are in the 3,000 hit club. Couple notes on that. There's only 31 Major League Baseball players to have over 3,000 hits, and only 3 of them have done that, their 3,000th hit on a home run, and that was Derek Jeter, Alex Rodriguez, and Wade Boggs of the Boston Red Sox. Only 2 players have done it on a triple, which is Ichiro Suzuki and Paul Molitor. And there's only 2 players in the 4,000 hit club, Pete Rose and Ty Cobb. And probably the greatest hitter of all time is Ted Williams. And Ted Williams only had just over 2,600 hits, but his career was cut short for his service to our country in World War II and the Korea conflict. So couple little baseball stats for the day to get you started. But Derek Jeter's quote, I think, can be transposed to any industry, especially the insurance industry. There's always going to be someone who's more talented than you or I are, but there's no excuse for anyone to work harder than we do. So hard work and grinding it out can always earn an extra sale. So today's topics that we're going to go through: the importance of living benefits on life products. Critical illness, chronic illness, and terminal illness are your traditional 3 living benefits. And of course, we're going to be going through the FLX series and the index product specifically with living benefits. And before I go any further, I do want to let you know that within the webinar, I have provided 5 handouts. So with those 5 handouts, we have the quick reference guide for the indexed UL product that you can click on, download, and keep, as well as for the term product. And we have a nice living benefits consumer piece that's consumer friendly and compliant that Ameritas has put together. So that's a great piece to share with clients on the importance of living benefits, as well as some URL information. So anyone new to URL, there's a PDF that's how to write life with URL. So it's who to call for term, disability, long-term care quotes, who to call for final expense quotes when you have a case in, who your case manager is. It's a nice one-page handy sheet and handout for you. And then also, if you're new to URL, we have our new agent bonus information there as well as a handout. So I wanted to get started with the need for living benefits. Living benefits on life, if it's not something you're promoting now or promoting occasionally, it's something I would, when you talk to clients, new clients, you certainly want to mention living benefits, what they are, what is available on life insurance. For your existing clients, when you do policy reviews, talk about living benefits. These are the new things in life insurance today. These are things that clients aren't aware of. When they think of life insurance, they think of themselves dying. That's not what you want to kind of leave as a lasting impression for your clients. Certainly you want to leave that legacy benefit to their families, to pay off that mortgage, pay off that house, possibly have a retirement supplement with an index UL. Those benefits that come along with life insurance for them, some of the selfish benefits. Living benefits are some of the selfish benefits that your client can use, and there's such a need for that today. If you look at living benefits, here's a couple statistics here of what's going on out there. 7 of 10 people turning 65 will need support over an extended period of time to meet their health or personal care needs at some point in their lives. $3,800 is the monthly national average cost for a home companion, and over $260,000 is the average out-of-pocket health care cost during retirement for a couple who retires at age 65. And about 80% of adults age 65 and over have more than one chronic medical condition. Every 40 seconds, an American suffers a stroke, and 1.5 million heart attacks occur every year in the U.S. That's one in about every 20 seconds. So when you're out there talking to your existing clients and new clients about life insurance, these are benefits that they can use when they need them. Couple of disclosures from our statistics there for you to look at and reference. And at URL, before we get started into the Index UL product from Ameritas, I wanted to go over some of the rewards for your business. For our new producers, we have our Quick Start bonus. And for our Gemini partners, we have a quarterly bonus. So if you're currently not a Gemini partner and need more information on that, after the call, you can certainly reach out to myself or my marketing staff on the How to Write Life handout. So any one of us will be happy to tell you about our Gemini Partner Program. In our Gemini Partner Program, you do earn quarterly bonuses. We have awards, retreats, and fun things like games to create a little bit of camaraderie amongst our Gemini partners. We have one going on right now for the Masters Golf Tournament. I'll kind of share with you some of the information on that. So our Gemini partners, if you can see here, we have a Gemini Partner Masters pool going on, and the winner is going to receive 2 tickets to the PGA Tour FedEx Cup at the BMW Championship at Aronimink Golf Course outside Philadelphia for them and a guest, with hospitality tickets for all you can hospitality tickets for the entire day for food and drinks and reserved seats on the 15th green. And our second place winner for the Masters pool receive an Odyssey putter. So on our Gemini partner page, we have our dashboard. We have our standings going on right now with who's in the lead. So it's a fun little thing we try to do for our Gemini partner agents. So secondly, on our Quick Start bonus, we have a Quick Start bonus for new producers and any agents who are returning to URL who haven't written a piece of life business in the last 24 months. So your first case, we give a $25 to $250 bonus per case, depending on the size. And you'll receive a bonus for any business you write in the first 90 days with URL. And our Gemini partner bonus, For traditional life business like term or IUL, any case sizes of 1,000 or greater, we start the bonuses there at $100 to $200 to $300 per case. And if you're writing final expense, we also have a final expense marketing bonus as well as disability and critical illness. Upcoming trainings over the next 4 weeks or so. At the end of the month, we'll have the COO and Senior Vice President of Cincinnati in our office to kind of review what's going on with Cincinnati Life Insurance Company, as well as our life field manager from the home office. May 4th, our first Friday webinar, will be going over Disability Awareness Month, information and marketing for disability during the month of May, which is Disability Awareness Month. And we'll also, as always, have our first Monday webinar on final expense. So without further ado, I'd like to hand the reins over to Eric to go through this exciting new indexed UL product with living benefits. Not only is it one of the strongest, or if not by independent standards, strongest performing index UL in the market today, it also has some extremely strong living benefits as well on the product that I don't want to steal Eric's thunder. And I will hand it over to you, Eric. Thank you for being on the call today. And just bear with me, everyone, while I give this, change my presenter to Eric. Eric, the floor is yours.
All right, great. Thank you, Steve, and thanks everyone for attending today. Let me get this on the first slide here. All right, so today I'm going to be talking about the FLX Living Benefits IUL. It's a new product that Ameritas kicked off here on February 26th to complement the term product that we already had for sale, the FLX Living Benefits Term. So I am Eric Ojeda, the internal wholesaler for all of you, and I also head up our internal sales desk. So we're just a resource here for you. Anything and everything related to these two products, whether it's how to fill out an e-app, how to get illustrations, questions on the products, any and all the above. So today we'll spend most of the time going through the FLX Living Benefits IUL and all of the great features that this product has available for you and all of your clients. So we've been working on this product for probably a little over a year, I think 16, 17 months now. And when coming out with an IUL, we already knew, IULs of the past, and then everybody refers to, do you have the new life insurance, the new IUL, and that's IUL with living benefits. So we wanted to take that one step further when creating an IUL. We wanted to outdo the new IUL and come up with our own new IUL. So the new IUL offers all the things that we're used to with an IUL: death benefit, the ability to grow cash accumulation, the ability to pull income, living benefits, and the overall experience when selling IULs. And we enhance all those categories to make it an exceptional product. And we feel that we encompass everything: living benefits, growth, income, legacy, and experience. And I'll touch on each of these one by one and talk to you about how Ameritas is unique in all these strategies. I also call this product here, this is a little pie chart, but I say this is the Swiss Army knife of IULs because it can do so many things for your client. Even when you've used one benefit, there are so many more benefits that you can use in the future. So first, we'll talk about our competitive advantage with the growth story. That's a big function of IULs, overfunding IULs for the ability to build cash value to rely on for some point later in life, whether that's supplemental retirement income or just having some sort of a nest egg or maybe college planning. All of those tools are available. And we think we've enhanced the growth potential because of our unique and index options and the way that we credit our interest. So our competitive advantage is we have 5 point-to-point index options, including a proprietary volatility managed index that you can only find on this IUL. And it's called the BNP Paribas Momentum 5, which we'll talk about a little bit later. And we also offer an account value bonus in the 11th year and beyond at 50 basis points, guaranteed never to be less than 25 basis points. And before I get into the details of all the index options that we offer, Steve mentioned having a great story with this product when it comes to growth. And if you follow IUL Digest, which is a newsletter that comes out and gives all the updates and all the great news that's available for all the IULs out there, when this product launched, and still to this day, it was ranked #1 for 20-year and 40-year growth potential. Okay, out of 118 IULs on the market, this Ameritas product was ranked #1. So we came out of the gate with a great product that can really do some good for your client when trying to build cash value. So it wouldn't be an IUL without the ability to offer the S&P 500. That is a household name, and all your clients will be familiar with that if they know anything about the market. So we wanted to make sure that we offered the S&P as one of our index options as well. And we have 3 different ways we can credit the S&P. Most common, obviously, is the S&P on a 1-year point-to-point. We offer a 12.25% cap with 100% participation. And then we have the S&P on a 2-year point-to-point with a 30% cap and 100% participation. And then we wanted to offer an adjustable participation crediting as well. So we offer the S&P 1-year point-to-point, 7.5% cap, 140% participation. So the great thing about our adjustable par on the S&P 1-year point-to-point is that we credit apply the participation rate after the interest has been credited, after the cap has been applied. So the client actually has potential to earn higher than that current cap of 7.5%. Where most IULs out there with an adjustable participation apply that participation rate before the actual cap has been applied. So they actually don't have the opportunity to earn more than the cap. They can just take their interest earnings up to the cap. So the huge advantage to Ameritas. If you look at the overall returns of the S&P over 2015 and 10, 5, and 1 year, the first row shows the 1-year returns averages of the S&P. So over a 20-year period, the S&P's average right around 6.8%. If you look at our 1-year point-to-point with a 12.25% cap, on a 20-year average, we have actually outperformed the S&P right around 7.3. And the 1 year with 140% participation has pretty much stayed in line with the S&P. And if you look at the 1-year return there, that shows you how we can outperform what the actual cap is for that 1-year point-to-point with the 140% participation. And then the bottom 2 rows are talking about the S&P on a 2-year point-to-point. So the S&P actually averaged over the last 20 years 7.18. We came in right around 7.5. So good solid returns as you would expect with an S&P index. Next index we offer is the Russell 2000, another pretty commonly known index. So we offer a 1-year point-to-point with a 9.5% cap. And you can see the historical returns there. We feel a lot of money will go into the S&P, of course, everybody knows it, but we also suspect because of this proprietary index, we'll see a lot of premium dollars going into this index. And with the apps that have come in already, and there's been a lot of them, we have seen a good mix of S&P and BNP. So the BNP Momentum 5, again, a proprietary index. You may have seen it on an annuity with another carrier, but it is the only index or IUL that offers this index. It is rule-based. It's an index that's looking to produce steady positive performance, even in a volatile market. So they diversify it in a lot of low-risk investments. And if you go to the website listed there under Learn More, you can actually see on any given day the underlying investments to the index, and they change every single day. They constantly manage this and look at the risk on a daily basis to make sure that this can be a performer even in a volatile or a down market. So it's a great index that can provide steady stream, and the way we credit can provide a lot of potential for income, and that's why this product is ranked #1. So with the BNP, we offer 2 different crediting methods. We have the 1-year point-to-point and the 2-year point-to-point. Both of these are uncapped, and the participation rates are where the real story is. On the 1-year point-to-point, we offer 170% participation. And on the 2-year point-to-point, it's even better, 205%. If you're familiar with the IUL world, you're probably not seeing many participation rates higher than 140%, if any. So this is a great story. You know, you look at lots of different IULs and how they all illustrate what illustrated rate do they use. In reality, it's an illustrated rate. It doesn't really matter. What matters is the potential for growth. And when using the BNP, it's a far more potential of growth than you'll see with other carriers. So looking at the BNP, we back tested it to see how this would have performed over the last 15 years. So the BNP on a 1-year point-to-point basis in itself performed with an average of a 6.8% return over the last 15 years. So pretty conservative. Those returns are very, very in line with the S&P. But if you look at adding in 170% participation rate, that is the real story. On a 15-year average, we would have credited 11.9%, almost 12%. On the 2-year point-to-point, the BNP would have averaged a little under 6.5%, but with the 205% participation rate, we're over 12.5%. You're not going to see returns like that with any of the other indexes because of the high participation rates that we offer and a steady performer like the BNP. Also with the growth story, not only do we have the amazing indexes and the high participation rates, but we have an account value bonus. And the bonus is 50 basis points in the 11th year and beyond, never to be less than 25 basis points. So everybody has a bonus. It's pretty common that you'll see bonuses on IULs of some sort, but you got to understand how the bonuses work. Some are guaranteed, some are not, and some are tied to multiple things. So having a bonus that is certain is a huge advantage to Ameritas. So if you look at the bonus world, we know Ameritas in the 11th year and beyond is going to give 50 basis points, never to be less than 25. If you look at competitor or company X, we'll call it, they illustrate 60 basis points year in, year out, regardless of how the index performs. In reality, what they're actually offering is 10% of the interest or 60 basis points, which is ever less. So it's tied to the performance of the index. So if they earn 0 in a given year, they're not getting 60 basis points, even though it's illustrated, they're getting 0. If it performs at 2%, they're getting 20 basis points. So they're not actually getting the 60 basis points unless they return an interest rate of 6% or higher. So if this were in the S&P, for example, and you look at the last 15 years, 4 of those were negative, 4 of those were under 6%. So 8 out of 15 years, they would have not received their 60 basis point bonus. It would have been less. So their illustration isn't actually matching up to what they were getting. And if you go back to 1950, 27% of the time, the S&P actually was negative. So that's a huge chunk of time where they were not getting this bonus. Ours, again, not tied to the bonus, they're going to get the 50 basis points. So in addition to the growth story, we all 0% floor. We have a premium deposit account. So if you do have clients with lump sums that they're trying to funnel in over a period of time, we can do that through a side account. And then we also have the ability to dollar cost average from the fixed account into the index options. So that is a great story when it comes to the growth. And we have an even better story when you add in the living benefits and all the things not only that it can do to cover critical, chronic, or terminal illness, but all of the things that, based on our approach to living benefits, allow the policy to continue to do for the client. So just like on our term product, we have 18 living benefit triggers. But the way we approach living benefits on our IUL is different than how we approach it on our term as far as the payout's concerned, and it's different than almost every other IUL in the marketplace. So before we discuss the lean approach on our FLX IUL, let's just discuss how it works on every other IUL with the discounted approach. So if you know much about living benefits, using a discounted approach, if you file a living benefits claim for critical, chronic, or terminal illness, the insurance company will take that claim, and then they'll determine the amount that you can actually accelerate based on your severity of illness or life expectancy. So even though the contract says we'll give you 90% of your death benefit up to this number, it actually could be much, much less, depending on how severe the illness is and how long you expect to live. If you have a long life expectancy and it's not that bad of an illness, you're going to get much less. And you don't know till you file the claim and it's underwritten. And also with the discounted approach, let's say you file a claim and it's a moderate or less severe, and they tell you can get a certain amount. Any way you look at it, if you take a full acceleration, that IUL is gone. There's no more death benefit, no more cash accumulation. Everything you worked so hard to do to build up this cash value for retirement is no longer. The plan fell apart. With the lien approach, it's a little bit unique. That's what we offer. The amount that your client's eligible for to accelerate is transparent and guaranteed. They'll see the amount right when they look at the first illustration, even before they sign the app. It's a percentage of the death benefit up to a cap, and it will never be less than what the illustration says. And also, if they file a claim and take a full acceleration, they still have death benefit remaining. It's a lien on the death benefit. So the policy can still continue to work. They can still overfund their policy and build cash, so the policy can still meet its original goals. So how do we pay out our living benefits? Well, if it's terminal illness, 12 months to live or less, we'll pay out 75% of the death benefit up to $1 million as a lump sum. Chronic illness. They can't perform 2 of the 6 ADLs or severe cognitive impairment. This does not need to be permanent, and it can even happen within the first year. There's no 2-year enforced limitation rule here. We'll pay out 50% of the death benefit up to $1 million as a lump sum. Again, no underwriting at the time of claim. They want the full 50%, they get it.
Eric, can I please interject real quick on the chronic illness?
Sure.
When you say it does not have to be permanent, can you expand on that just slightly as why that's important and why that's a good thing?
Sure. Since it doesn't have to be permanent, so a lot of carriers require that the severe cognitive impairment or the inability to perform 2 of the 6 ADLs is permanent. Permanent is a long time. It's probably a lot easier to say, I currently can't perform 2 of the 6 ADLs. I currently can't dress myself or eat or feed myself. Okay, so current means it's not forever. So I would imagine that in many cases of severe cognitive impairment or the inability to perform 2 of the 6 ADLs, that could be a temporary thing. You get in a car accident and you're not able to do some of these things for a period of time. You go through a rehab. You see the potential for these things to come back. If it's permanent, that's saying you'll never recover. I would much rather be able to file a claim for something that I know I can recover from and rely on that money when I need it. So hopefully that explains that a little bit.
Yeah, thank you, because not all, as you're probably starting to get the idea, not all of these living benefits are created equally, and that's why we really wanted to get Eric on the line today from Ameritas to really show the value of these living benefits here. Thank you.
Sure. And the other thing I mentioned is, the policy doesn't have to be enforced for 2 years to file a claim. There are carriers that say, if you want a chronic illness, you can't do it in the first 2 years you own the policy. Ours, you can do it from day one. There's just a 90-day wait after you file a claim. Critical illness, we have 15 living benefit triggers. So that is pretty expansive list. And if you have a critical illness, you can get 25% of the death benefit to a maximum of $250,000. Again, no strings attached. You want the full 25%, it's yours. I will say, when it comes to critical illnesses, most carriers have a 90-day wait before you can get money for a critical illness. Out of 12 of these 15, there is no waiting period. You can just file a claim and get your money. Not only do you have the ability to file your claim and get your money right away because of no waiting period, so the carriers that do have a waiting period for critical illness, well, not only do they have their 90 days or whatever it is, but you also have the waiting period for that claim to get approved. That could take months and months and months. With our critical, chronic, and terminal, again, there's no severity of illness or no life expectancy. That's not going to slow down your client getting the money. Now, I've talked to a lot of agents that have filed claims for critical and chronic and terminal illness on IULs, and they say, well, for one, I have to have the conversation with my client saying, you might not get the full amount that you think you're going to get. So that's a tough conversation. And then the second conversation is, I know you need the money, but it's going to take some time because they have to evaluate your situation. You don't have to have those conversations with the FLX IUL. So we feel it's a great story. I already mentioned we have a term product. Because we have both approaches, on the term, we offer the discounted approach because you can't offer a lien approach on term. So we believe a lot of people will sell our term for their death benefit and their living benefits policy. And they'll buy our IUL for the ability to overfund and have cash value and the potential with the BNP, as well as guaranteed living benefits. So potentially they could file a claim with both policies and say, I wonder how much I could get on the discounted method. That's not enough. I'll take it guaranteed on the IUL and the lien approach. So I said lots of information about lien versus discounted. So actually, how does it work side by side if you look at it? So we're going to look at the lien versus discounted. We have a $500,000 death benefit. So if a person has a critical illness, we know with the Ameritas policy, they can get 25% or $125,000. So if they max out, take their full $125,000 they're eligible for based on face amount, it's a lien on the death benefit, a lien on the cash value. So they would have $375,000 of death benefit remaining after acceleration. And that's with a full acceleration. On the discounted approach, the potential is a lot higher. That's why we love our term policy. It's more potential for living benefits. But it could be much, much less. So they could get anywhere from $2,500 to almost $382,000. Again, they don't know until they file a claim. $382,000 would be a very, very severe critical illness. Either way you look at it, whether it's $2,500 or $382,000, if they take the full amount that's eligible to them, their remaining death benefit is zero. And if you don't have any death benefit, you don't have a policy, you don't have any cash value. Everything's gone. Their whole plan for overfunding and using it for retirement has disappeared. So let's look at a real life scenario. We have a 40-year-old preferred, putting in $500 a month or $6,000 a year, max funding. So low premium or low death benefit of $400,000. So they fund this thing for 20 years, going to use it for retirement at age 65. So they got 5 years to go till they can go to the retirement years. But at age 60, they have a heart attack, a critical illness. So the problem is, how does the family get through this crisis without sacrificing the 20 years that they've spent building up this cash value? And they've stuck to it. They've done exactly what you told them to, and they kept funding their policy like they planned to. So how do they avoid this falling apart and affecting their retirement years? So we have Ameritas versus Company X. As far as overfunding, the death benefits are roughly the same. The cash value in year 20, Ameritas edges out Company X. Now, Company X, this is a moderate illness. We know Ameritas gives 25% of the death benefit, so here it's $98,000. With Company X, they offer the lien or the discounted method, so it's based on severity of illness, life expectancy, so they have potential for more. So here, yes, they got more for a moderate critical illness claim, $243,000. So if they do the full acceleration with Company X, they take the full $243,000. There's a lot of zeros. There's no more death benefit, no more cash value. There's nothing in the future. If they take the full acceleration on the Ameritas policy of $98,000, they still have $294,000 in death benefit remaining, $120,000 in cash value, which will continue to earn interest. Also, that liened portion of the cash value, that $98,000, will also continue to earn interest, kind of like a variable loan. It still participates in the index. It's still considered part of the policy because they could pay it back if they wanted, and they could overfund if they wanted. But in reality, this thing can continue to grow, and at age 85, they'll have almost $1.2 million of death benefit and cash value. So you may say, Eric, that's not really fair. You're not showing apples to apples. So let's do that. Let's say Company X client says, I don't need 243. I'll take a partial acceleration. And you can take a partial acceleration on either method. So here they take a partial acceleration of $98,000 to match the Ameritas policy. Death benefit after acceleration still less than the Ameritas policy. Cash value after acceleration is still less than the Ameritas policy. And the death benefit grew, but it still grew to less. So did the cash value less than the Ameritas policy at age 85. So here Ameritas wins, and here Ameritas wins. Either way you look at it.
Eric,
so
I have
you may
a quick
say,
question.
Yeah.
I apologize. I have a quick question. So let's say that's on $500 a month. So let's say this 40-year-old wants to get into this type of plan, and wants to start maybe supplementing retirement. Maybe they're funding a 401k or doing putting money in an IRA or a Roth, but they wanted something additional. So they're looking at IUL. They're liking the product with the living benefits, but they're like, I don't have 500, I have 250 a month. So, if we max fund that, that's going to be somewhere, if this was 400,000, that's somewhere in the neighborhood of 200,000. So at $200,000 with Ameritas, is that full medical underwriting, or can you do non-med? Meaning like no paramed, or can you have a choice between the two? What's available there on underwriting?
So both on the IUL and the term, if they're age 60 or younger and the face amount's 300,000 or less, it is non-med. So just the application. There won't be any paramed or anything like that. So, and here's the great thing about our non-med, and people always make me repeat this twice because they don't understand it, even though it's pretty simple. On a non-med basis, not only do we offer rapid tobacco, rapid non-tobacco, which includes tables A through D. We offer standard tobacco and standard non-tobacco, but on a non-med basis, your client can actually qualify for preferred non-tobacco. So I think we're the only carrier that offers preferred on a non-med basis.
Great. Hey, thank you. Appreciate it.
Sure. All right, so we looked at kind of comparisons, and we looked at what things might look like, but how does it actually work? How does the policy work for your client if you have an acceleration? So here we have a client that's 45 years old. They need $1 million in coverage, and that would give them lots and lots of living benefits as well. And they want to max fund this. So the premium is roughly close to $19,000 a year. Now that's a lot of premium. Hopefully some of you have clients like that, or you run into one every now and then. But really the story works whether it's $500 a month or whether it's $1,500 a month. This client, $19,000 a year, $1 million policy. I'm going to use it for retirement. 5 years go by, they're now age 50, and they have cancer, prostate cancer, let's say. And it doesn't matter if it's stage 1 or stage 4 to us. Of course, it matters to them. But we don't care how severe that cancer is. It's going to pay the same regardless of what the severity is. So they can accelerate, we know 25%, they would max out at the $250,000. So they accelerate, take the full $250,000. Right away, they have $750,000 in death benefit remaining. Now, this client had this critical illness. They're still, maybe they took a little bit of time off work to recover, but they're still able to work. They can still fund their policy, and we hope they do. They fund their policy to continue with the $19,000 per year. And you can see their death benefit, since it is a lien and it has an interest rate tied to it, does go down over time, not drastically. You can see the lien balance there as well. So this client has a full acceleration. Since it's a lien approach, they still have the policy in force. They can still overfund it. Full acceleration on the discounted, they can't overfund it. It's gone. So there's a lot of flexibility in what they can do. So the years go by. At age 65, they retire. So 15 years have gone by, and their death benefit is still $637,000. It has not dropped drastically since that acceleration. But the great news here is they can start their cash flow, their income stream that they originally set this policy up for. Almost $54,000 can come out of this policy each year for a 20-year period. And then when all said and done, at the end of 20 years, they want to stop their income stream. Maybe they're now relying on some other income. They still have a death benefit of $135,000 remaining. And as long as they keep $1 of cash value, that death benefit will remain in force. So great story here. And that's why I say it's a Swiss Army knife of IULs. They've used this policy not only for death benefit, they used it for a critical illness claim. They used it for cash accumulation. They used it for income. And if they had another critical, chronic, or terminal illness claim, they could have used it again for that. So there's lots of reasons they can continue to use this one policy. So I mentioned you can accelerate many times. So the client has a $300,000 policy. They have a critical illness. We know they're eligible for $75,000. They only want $25,000. They can do that. And that would allow them to accelerate again for another critical illness, $50,000 later on. And then they could get a chronic illness and get 50% of their current death benefit. So all in all, they can get up to 5 accelerations on their one policy. So that is the living benefit story. Now, legacy means death benefit. Of course, IUL provides death benefit, just like any other life insurance contract. But we've established that it provides death benefit even in the event of a living benefits full acceleration claim, which other IULs do not. And knowing that there's a lien on the death benefit when filing a claim, clients get worried, well, will I have death benefit? So as that death benefit goes down over time, we ensure, based on the contract, that they will never have less than 10% of their death benefit remaining. And if they want more than that, they can purchase a rider for an additional cost where they can get 20% of their death benefit remaining. And then income. Of course, you can have the income story, taking withdrawals, the cost basis, taking loans, whether they're fixed or variable. We have all that. And we also have a lifetime income rider, which I'll talk a little bit about. So fixed loans, pretty competitive fixed loan. It becomes a wash loan in year 6 and beyond. Variable loans participate in the performance of the index, so they have the ability to have a variable loan. And they can also have the ability to change what type of loan their loan is once per year. So if they start out with a variable loan and aren't comfortable with it and want to make it a fixed loan, they can do that and then change it back a year later if they'd like. And then the enhancement on the income story is the lifetime income rider, which is still pretty unique on IULs. You see it mainly on annuities, but we have the ability to offer a lifetime income rider for no additional cost until they turn it on, and they never have to turn it on. But if your client ever determines that instead of taking that hypothetical income stream, they want something guaranteed, they feel more comfortable with the guaranteed income, they can turn on that rider. And for a charge, which is currently 10% of their cash value, we will take their current cash value and turn it into a guaranteed income, whether it's level, or they could choose to have it increasing at 3% a year, or potentially increasing, never less than 4%, but also tied to the market. Of course, we have overloan protection, prevents a policy from lapsing because you've taken too much money out. And then one other rider I didn't mention that kind of goes with the growth story is if you do have a lot of business clients that are looking for early cash surrender value, we have an early cash value rider. You can make up to 80% of your cash value available in year 1. So part of the other competitive advantages are the overall experience with Ameritas. We already mentioned the non-med on the term and the IUL, age 60 or younger, 300,000 or less. So we know that you like to get things issued quickly, and then that's why we have non-med. We also have an advantage of being a mutual company. So being a mutual company, we're here for the clients, the policyholders, and for you. So part of being here for the policyholders, we get asked a lot, so many companies are lowering their cap rates on in-force IULs. Will Ameritas do that? We've never done it. We could, we've never done it. And why we feel that we won't is we are a mutual company. We answer to our policyholders. We don't feel it'd be in the best interest of anyone to lower caps on an in-force book of business in order to give other policyholders a different benefit. We feel everybody should be treated the same. If one gets lowered, everybody gets lowered. If one gets raised, everybody gets raised. Everybody's treated the same. So we feel that's not something we would do in the future. And also being a mutual company, we're here to partner with all of you and give you access to everyone. You obviously have access to the sales team, but you also have access to our underwriters and our new business team. Anyone and everyone that helps you with your business. We're not going to cut you off or not let you talk to certain individuals. You can talk to everyone. So we've been around since 1887 in Lincoln, Nebraska. These numbers are a little bit old, but they're roughly the same. So we have over 4 million customers. We've paid out $2.6 billion in benefits with all of our products in 2016. We have over $26 billion in assets under management. So these numbers say we're a big enough company to matter, and those other companies out there, you know them all. They have taken notice, and they're getting a little worried about these FLX products that we offer. And we're small enough to care. We care about you and all of your clients. Of course, we're rated by AM Best and Standard & Poor's. If you need anything at all, there's one number. So forget Googling Ameritas or going to Ameritas.com to try to find a phone number. This is the only one you ever need. And you'll hit 1 for FLX products, and then there's a menu for sales, new business, underwriting, contracting, commissions, as well as in-force. So one number to be used for all departments. And so I mentioned the term a little bit on the term. As far as the living benefits, still all the 18 living benefit triggers. The term is on the discounted approach. So you can get 90% of the death benefit up to $1.5 million. Again, all the triggers are the same. All the same rules apply. Non-med is the same. We have a way you can get discounts on our term. If you have 2 or more FLX policies being paid for by the same bank account, the term will get the policy fee cut in half. Okay, so if you have an IUL and a term, on the same insured being paid for by the same bank account, that counts. If you have a husband and wife getting term, that counts. One of them getting an IUL, one getting a term, that counts. As long as you have 2 or more FLX policies, the term policies get a reduction in the policy fee. And then brand new, we don't even have the flyers available yet, but I will clue you all in. I don't even know if Steve knows this, but we kicked off a bonus program on April 1st all the way through June 30th for our FLX term. So here's how it works. For each FLX term, again, term only, each FLX term policy that you place, get issued and paid, will pay you an additional $50 per policy. If in a given month, so the first to the end of the month, you get paid $5,000 in term premium, you'll get a $500 bonus. So the first bonus, we pay those out weekly. The monthly bonus, we pay out once a month. And then there's a third way to get bonus. We know that you're choosing to do business with us, and your time is money. So we want to have an experience bonus with the term. If on a non-med term policy, it takes longer than 10 business days to issue that policy because of Ameritas, not the agent, but Ameritas, we'll pay you $50 per app. Or not app, for place policy. On a fully underwritten, if it takes longer than 20 business days to get the policy issued because of Ameritas, we'll pay you $50. So not only do you have a chance to earn $50 on every placed app, you have the premium bonus as well that you could earn, and you have the potential that you could earn some extra on the back end because things are taking a little bit longer on a particular policy. Again, we know that you having to follow up on things like that costs you money, so we want to make sure you get rewarded if it's because of us that you're having to do that. So again, thank you for your time, and looks like we got some great competitive piece that Steve's bringing up now.
Yep. Great. So thank you, Eric. Greatly appreciate it. Thank you, everybody, for being on the call today. I just wanted to share this with you, this competitive comparison on the Ameritas FLX term with living benefits to show the other carriers in the marketplace, competitive carriers in the marketplace that offer these benefits. And you'll see that. So not only is there a great bonus to kind of kickstart business with Ameritas with the FLX term series, you can double dip that with URL's new agent bonus. And any quotes you may need, you can either contact URL, and I'll bring that up here. You can contact URL, and you can contact Joey Fry, extension 157, myself primarily, or Matt as our third option for term IUL quotes. We'll be happy to help you with those. And you would give us a call. We'd be able to get you those quotes as well. Secondly, you can also get the FLX term on our website. So if you are at URL's website on our term quote engine, you'll see the FLX term as one of the options that you can quote and get premiums for your clients. So great, it's great. It's right there on the website. So whether you're using our website for quotes, for term quotes, you can get it there, or you can certainly give us a call, send us an email. We'll be happy to help you out with that. And again, I appreciate everyone being on the call today. Thank you, Eric, again, for your time. And if anyone has any additional questions, needs any information, contracting, paperwork, please reach out to us and we'll be happy to get that to you. I don't see any questions at this time, but please certainly give us some feedback. And next month's First Friday webinar will be kind of celebrating Disability Awareness Month, and we'll have some great content and marketing ideas for that. Thanks again, everybody, and take care and have a great weekend. Bye for now.